This is a Rogue Media Network podcast.
Hey, it's Christina.
Hey, it's Jenn.
Hey, it's Cate.
Real Estate Misfit Moms. I don't know why I have all these songs in my head and they're all 80s. Here we go again on my own. I don't know why.
That's okay.
Going down the only road I've known.
I feel like I need to have like this light that's over here like spotlighted on you so I can like 1920s style like grill you on things that happened during the loan and what all the words mean. You know, what
There are so many.
What are they?
Are we starting now?
Yeah, we have started.
Yeah, we've started.
Oh,
TWAs,
Where was
three-word
I?
abbreviations. Well, you're still writing some.
Oh,
text
I was like, TWA.
yeah,
What's that?
see? 3-word abbreviations or something like that.
Yeah. Well, and
What is TWA?
3-word
abbreviations.
abbreviations.
That's what I was like, am I supposed to know what that means?
You just said it 3 fucking times. Also, I am
Yes,
such a
it's okay.
ding dong.
It is okay, but
Do the viewers think I'm stupid? Should we do a poll? Like, do they think I'm the dumb one of the group?
I don't think anyone's ever commented that.
Has anybody ever commented at all?
yeah, couple,
Like,
few.
Couple comments.
So
Might be ours.
because I feel like they don't in realtor school, they're not like, this is what all these acronyms mean, do they?
No, we take a whole section on like,
Acronyms.
but they have to do with ours. But like, we do a whole section on like lending, but we don't actually go into the words that probably matter the most. And unless you've bought a house, you don't know what, like your principal and APR interest.
And a lot of times when I'm talking to people, so a lot of times, like first timers especially, I always have a hard time with too much information, not enough.
Yeah.
Because, in my mind, I want to say, okay, here, we're going to go through the payment. This is your principal, your interest, and I want to break down. But I think that sometimes there's so much the person's going.
So we have a form. It's like 4 or 5 pages or something. It's not like every term, but it is like a lot of the terms that we might so when I give it to people, I'm like, this is actually not part of your contract, but this is like a lot of the terms that you might hear in the process. And it starts like appraisal, broker, there's just movable soils, stuff like that, environmental concerns.
Yeah.
And it's kind of like a glossary of terms.
Do you feel like they use it? Does it help?
I point out the ones that matter the most in like our territory. 'Cause some of them are territory driven, like Tidewater. Like we don't have that. Like what's confusing is when I have a VA and they'll say, "Oh, but you told me Tidewater didn't matter." I'm like, "Yeah, but this Tidewater is your appraisal Tidewater, not Tidewater as in the ocean Tidewater." But why they decided to name that process Tidewater,
That is odd to me.
But I do think that people do use it to an extent, and I think it's okay that they ask questions. But I think it's one of those things where I'd rather give them that information as a reference point to start off with.
Yeah, that's a good idea because there are so many, and some people. I think it depends on people's personality, but some people are like, well, if I ask, I'm stupid. You're totally not.
No, if you ask 3 times, you're still not stupid.
Right, yeah, for sure. I remember when I first got into mortgage, I literally was the person that answered the phone, and so I sat in the middle. And I distinctly remember people saying, 1003, 1003, 1003. I remember sitting there going, I'm not asking anybody what that means.
What does it mean?
Now, that it's an acronym for the application, the URLA, URLA, Universal Residential Loan Application. Why it's a 1003? I think that's
that's a form number,
isn't it? That's the form number, yes.
Oh.
And, because I'm kind of old school and been around for a while, I call it the 929 OOA. It is the HUD addendum. But if you say to somebody that's in the mortgage business, you're like, it should be on the 929 OOA. And they're like, what's that mean? So if they haven't been in the business for a long time, that's not what they know it by. They know it by the HUD addendum. Because you're like,
Kate, what do you know that document as?
Because there really are so many.
Yeah.
But that's not something I would ever refer to a customer.
Yeah.
They'll the things that
I'm
I'd
like-
say to them would be like principal.
I think the difference in this conversation we're about to have is that Kate really deep dives into every aspect of
She does.
life to include mortgage, real estate, geographical competency, Mason-Dixon line, like all these things, like all of them. And I'm over here like,
You're like, I'm in my lane. Don't want to see yours.
yes, I would know the parameters. I know like all
Right.
this, but like I'm not Kate, and so like I'm over here like,
Who cares?
Kate, what do you know it as? Because Kate probably knows that document and knows how. I'm like, I don't know that document. I'm not sure.
I will tell you, she's a little different from other agents. Like one of her team members one time sent me a text message, and I hadn't worked with Justin a couple times, and he sent me a text message, and he was like, "Is that with the DU approval?" And I'm like, nobody asks me that, but Kate. No,
The what?
it's the desktop underwriter. Like you can send it through an automated approval system. And Kate taught her agents to ask. And I was like, oh, Kate must have told you that. He's like, yeah, he was so proud of himself. And I'm like, yes, sir, it is.
Because in the height of the market, when everyone was getting 75,000 offers in, 0.2 nanoseconds, you'd have lenders just like, and you get a letter, and you get a letter, and
It's
you get a
Oprah.
letter, and you get a letter. And there's still that, right? But like now we have the time to like, breathe and pee and do all the things, right? We have probably more time than we want right now. So I always told them there is an automated system that they go through that they not only do they have to submit some stuff to get through this system, which means they had to already submit all their documentation.
Yeah.
That got put into a computer and AI read it and AI goes, yep, on the surface, they're going to get approved for this loan.
Right.
That's called a desktop underwrite. And then, so a lot of those people weren't desktop underwritten. And if the agent didn't know what a desktop underwritten was, I'm going to tell Sally Seller, hey, this agent doesn't even know if this lender has fully run out their stuff. And so when you're evaluating, 17 offers, that's important to know that the lender knows what this person is, because my job is to get you the most amount of money
Right.
with the deal that is to the best of my knowledge, guaranteed to close.
Right, of course.
And so if you're not desktop underwritten, then I can't, you're not,
don't know.
You're not at the top of the list.
Well, and
I never made it there then.
I could go on and on about that whole thing because people, realtors want, can you give me a pre-approval letter really quick? Sure, I can do anything you want. Do you want me to look at it though? Like, so that's the thing about things is they want it to like, I need a pre-approval letter in 5 minutes. Okay, well that's great. So here's a pre-approval letter. It's as good as that piece of paper it's written on because I don't have a pay stub. I don't have a bank statement. I don't have nothing. But here you go. So that's kind of where that comes from. I really don't like to give a pre-approval letter unless I have verified everything. And I'll put on my letter, assets reviewed, credit report reviewed, blah, blah, blah. But there are a lot of lingo words that
Well, let's go through some of the
you have to be careful.
lingo words.
Let's do it.
Let's do it. Okay, so what is one of the things that us as agents and then as buyers hear all the time is your DTI.
Oh yeah, I know what that means.
What's DTI? And there's
Go,
two
Jen.
there's two DTIs. There's your front end and your back
Yes,
end.
there is.
So what's DTI and what's your front end and what's your back end?
Go tell us, Jen.
Debt to income ratio.
Okay.
Bing ding ding. Oh, we need a like that was easy.
Yeah, that was easy.
That
I
was
used to have one of those.
easy. Oh yeah.
So
Okay.
front end is just house payment, just new house payment. Back end is new house payment plus all the debt.
So credit cards, car.
Yes. So when I say all the debt, it's going to be something that's on your credit report. So like not your electricity bill. Also, if you have a credit card that you send $100 a month for, but they only ask for $25, we use $25. So it's the minimum they asked for. I actually have a worksheet that some people that are real savvy like to use, where you can put in like, here's my income, here's my debts or
Do you
whatever.
do that? Kate?
Well, I'm not buying a house, so no.
No.
If I was buying a house, probably.
So it's the ratio.
I'm gonna need you to send that to me.
You mean you just don't do it for fun to see where you're at?
Funsies.
Well, no, because I have a pretty good idea of where I'm at.
Oh, me too. A lot of debt. No income.
That's funny. The ratio part
I think that's a 90%
Right.
ratio.
Well, and people don't get it. Because like I had a guy call me the other day, and I'm just throwing numbers out. This isn't. So he made $3,000 a month, and he wanted to buy a house where the house payment was $2,700.
No.
So, no, friend. Like, are you?
How are you gonna eat?
Because so
How are you going to have your bills on?
he literally has $300 to live.
Yeah. So how are you
Like,
gonna?
and he couldn't, in his mind, he couldn't figure out like where that was coming from. But let me also back up and say, debt to income ratio it can get deep. So it's the ratio of how much you make versus how much is going out.
Okay,
So
and it's a
that's-
percentage.
That's
so,
a percentage.
Right. So you'll tell me either that their loan they have to have below an 85% debt to income ratio or whatever, and you'll be
Which
like
is-
they're at 90, and I'll be like, oh,
Okay, yeah.
okay,
So,
yeah, got it.
As a general rule, you really want your debt to income ratio to be like at 50.
I was going to say, isn't it like 53 or 54% or something?
And that's the hard part. So, like USDA, they don't want it over in the 40s. But FHA will let you go to 55, 56 if you have really good credit. But conventional, they're pretty hard struck on. Sometimes if you have insane credit, you can get a 49.9 to go through. So, generally speaking, 45 to 50. That's where you want to be.
I could
Well,
not
and
get
they-
approved for nothing today. Let me tell you that.
They also a lot of the times will tell you, like, when you're saving to buy a house, to keep your credit cards below 20% of your credit line or whatever. So you're only supposed to use 20% of your actual total what the bank is willing to give you.
I'm maxed out on all those right now as well. Matt would be so proud of me.
Yeah.
Gold star. Ding. Okay, so debt to income, that's one of the first things that you
Right.
hear when you go through your loan process. The next one is going to be your interest rate. And a lot of people ask about
I know, don't do it to me.
Do it.
Do it.
A lot of people want to know about
it.
fixed rate
No, okay.
versus
Okay, that's not where my mind was. Go
Oh,
ahead.
but wait, where are you going?
I'm not, because I hate
Come
explaining
on, tell
it.
me and I'll
But
tell me and I'll ask.
But
Buy
I'll pull it up in
downs.
a minute, and then I'll read it, because it is very confusing.
and so then
Fixed and adjustable.
fixed and adjustable rates.
I actually had this conversation with somebody yesterday, and it happens often in their circumstance. They were doing a construction loan. And so a lot of times if you go to like a local bank and you get a construction loan, it is
They're on an arm.
adjustable. It's adjustable and or a balloon. So let's
Yes.
do those two things. So in this instance, their loan was going to be fixed for 5 years, and then it would start adjusting.
Also known a lot of times as an arm. which
Yeah,
also
adjustable rate mortgage.
Yeah, so ARMs, if you ever hear someone say, my mortgage is on an ARM, it is not the thing attached to your body. It's
Right.
an adjustable rate mortgage.
Which has a lot to do with why all hell broke loose in 2008.
Correct.
But so like in his instance, when they built the house or whatever, interest rates were a whole lot lower. And so I think he said he started at like a 4 or something. Well, as rates started moving, and like he's now like at a 10. And when you get your documentation for your adjustable rate, it will map out. This is how often it changes. This is the percentage it can change off of. This is the number that it uses to adjust from. It can get very detailed. Most people want a fixed interest rate. And so that's going to mean that today your interest rate is 6%.
And it's going to be that for the life of
And
the
in
loan.
30 years, your interest rate is going to be 6%.
So the difference, what we're hearing a lot now is, 2-1 buy downs,
Right.
3-1 buy downs. What is the difference between that and an ARM?
So there's 1-1, 2-1, and 3-1 buy downs. So the first number, the 1, the 2, or the 3, is how many years it's going to be bought down before it goes to the full term, the
big interest rate.
the full rate, I guess is what it said.
So if today's rate is 7%,
Right,
your first year you could have it at 5%,
right.
And then if you're on a 2-1 buy down, then it'd be 6%. Then on your third year, it'll be 7%.
Correct.
Okay.
Yes. So if you do a 2-1, then it changes. It goes. The first year it's down 2 points. The second year it's down 1 point, and then it goes to the full. And a lot of people are doing that because today, in March of 2024, people feel like interest rates are going
It's
to drop.
April.
Yeah, it is. It's the second.
It's April 2, baby.
He said so.
What are we? Second quarter?
Something like that. They think
I don't
that
know,
interest
quarter or
rates are
something here.
going to drop, and so they're doing these because if you do a buy down, another thing people don't realize is if you pay that mortgage off before you use all of the buy down funds, it goes towards your principal, so you don't just lose it.
Ooh.
Yeah.
Do you see people do? I know that you just said 1 year buy down. Have you seen people do that recently?
Yes.
Is it beneficial?
Yeah, it would just depend on what is your plan? What's your ultimate plan with the house? He's talking today.
He's loud today.
Yes, he is. Just depends on what your ultimate plan is with the property. You know, if, you know, I always try to talk people through it because it would just depend on each person.
So if someone was going to do a 1 year buy down, could they do it as a secondary home, or is that a
It's your
primary residency only?
Yes.
So I feel like a 1 year buy down doesn't make sense sometimes because
Right.
you want to stay in your home for 2 to 5 years for tax purposes.
Right.
Right?
Most people that have been doing buy downs at least do the 2-1.
Yeah.
The 1-1 is, I don't know that, I might have done maybe one, but not very many of those do I do.
Yeah.
So if you do an ARM, and this also applies a lot to commercial real estate, because a lot of commercial, like, they'll do it, especially when they're doing, if it's a big deal, they'll do partial owner finance and then partial bank finance. So they'll do the first part, if it's owner finance, owner finance is a lot of times are on a balloon.
Right.
So what's the difference between a ARM and a balloon?
So a balloon means that if you're on a 10-year balloon, a 5-year balloon, that means that when that year ends, it comes due.
The loan in full.
Yes. So either you pay the loan off or you take the balance and refinance it. Yeah. And that,
And your interest rate stays the same throughout the whole thing.
assuming you have a fixed rate balloon. But
Yeah.
you can also have an adjustable rate balloon.
So fun.
So-
Most of the time in commercial that I've seen is they do an ARM balloon.
Right.
And it's it's attractive to a seller
Right.
because they will get a massive payment at the end of 5 or 10 years.
Yeah.
And plus the interest, and they're getting the interest the whole time. So normally the down payment pays off their whatever mortgage they might have on it or note they might have on it, and then from then on they're just making cash, and at the end of that 5 or 10 years it's like the balloon pops and they're
Right.
like, now I have the dollar bills.
Right. Well, and the biggest thing is that's why it's so important to, like, really look at your stuff. If you're not looking at your documentation, then, you know, back when the 2008, 2009 all happened, a lot of that stuff happened where people didn't know they were on an adjustable rate. And so their interest rate, when interest rates started moving quickly, their house payment went up $500, $1,000, whatever. So most people are going to want a fixed rate mortgage, but they are available to do adjustable rates right now. Let's think of another one.
So one of the things that also was really popular during the height of COVID
Right?
was hard money.
Yeah.
What's hard money?
So the
I
truth
just saw
is-
somebody ask about a hard money lender yesterday
Yeah.
on socials, and I was like,
Because people are in such financial constraints
Yeah.
right now
Yes.
that they can't qualify. So
So the truth of it is you can get a mortgage just about for any scenario. If your credit score is 500, you can find a mortgage. But hard money is going to do,
can we just look at how funny he just was?
it's going to be, hard money is normally like you have a really rough situation. Like, let's say maybe you just filed bankruptcy last week but now you need to buy a house or whatever. So the hard money is normally going to mean that your terms are just not going to be.
usually your interest rate
Yes.
sucks, and it's often they'll call it due. They can call it due at any time. Like they
Yes.
could tell you that it's a term of 10 years or 20 years or whatever, but they can call it at any time. They can say, "Oh, sorry, I just don't want to lend you this money anymore,"
Right.
and they can call it due.
So the interest rates normally quite a bit higher. A lot of times you have to have more dollars down.
And you have to just know that you're about to get killed in your payment.
Yes. I mean, it's normally not a beautiful situation. I had one where they did a hard money because they were moving from another state to here. And so when you're moving, you don't want to quit your job until you have the other one. Well, they quit their job driving here from another state.
Oh, I know that one.
Yeah.
It wasn't mine, but I know this story.
Oh my God.
Yes. And so literally.
And they literally thought it wasn't going to be a big deal.
Yes. Like, it was like 2 days before closing, and I was like, so they called to do your final verification of employment, and they're saying you no longer work there. I know, we quit last week. We're driving down. I'm like, yeah, but that's a problem.
Yeah.
Because we qualified you on income you're not making.
Yeah.
What happened?
So they
got
did a hard money
money.
loan.
And they did it, like, in, like,
Days.
record time.
Yes.
Like, days.
Yes. So, but they called me within 6 months and was like, can we refinance? Because it was just bad.
Yeah.
So that's what a hard money is it's normally just not beautiful terms. Payment, rate, all the things.
Yeah. And I've also had them where we get to closing, and because it's hard money, they can set whatever terms. They're backed by people. They're backed by investors.
Right.
Like people that have money.
Right.
It's not necessarily banks that have money. It's people that have money. So they get to make the terms. There's no, like,
It's almost
No
like an owner
regulation.
there's no
finance.
regulation on it, right? So, like, I've had it where they said, like, their payoff was, like, say, like, $100,000. But then there was also, like, $75,000 in fees
Holy smokes.
because it was, like, this processing fee and this hard money fee and whatever. And so, like, when they were like, oh, we only have $100,000, so we're going to make this much. But when we got to closing, I got to the CD, I was like, whoa, this is not what we had, because the payoff says one thing, but then in the instructions for payoff,
It had all the other.
it had all the other fees. And so, like, they didn't know, because there's no online portal. Like, you know,
Right.
I go on to pay my mortgage, it's an online portal. Like,
Yeah.
I just pay my payment online. It's not like that. Like, you're sending money directly to their bank or whatever. There's not typically, like, a portal you're paying through. So, like, if you want your payoff, you have to physically go get it. And there's a person in town, he does a lot of hard money loans. He's a business owner. Usually it's his rentals that he does, you know, owner finance on, rent to own, whatever. And you literally go to his store, and on a sales slip from his store will write out what their payoff is. And when you go and pay him a check, he writes it on his, like, business, like, carbon copy paper, like, you know, the address, what they paid.
I wonder how much, so, like, I wonder how that would work. Like, if he decided to add 10 grand on it randomly over the last week, like, is there any repercussions? Like, could he?
I think some of them are, like, you know, napkin deals, right? Like, it's just
Right.
written on a napkin. Some are actual terms that they sign off on or whatever. But, like, sometimes those people don't even ever get, like, copies of what they signed.
I think that also falls into, like, the person who's purchasing, like, their personality.
Yes.
Like, oh, can this person pull a fast one on you? Probably. Do you pay attention to your paperwork? Probably not.
If
Okay,
you're in
I'm
one
getting
of
you.
if you're in one of
Yes.
those situations, right? Like, if you are looking for a hard money loan, a lot
Yeah.
of the times you're in a bad financial spot anyway.
Yes.
So chances are that we play with our feet a lot. Chances are you're in that situation and you're looking for that, and so the person knows that they're going to be able to pull a fast one.
You're so funny today.
I needed a neck.
You're so funny today. What's another one? Let's see. You made a list.
LTV.
Loan to value. So Cate made some notes. Chat GPT gave us the definition. They're a little much. So basically it's how much is your loan versus how much is the appraised value. It's another ratio. So if your house is appraised at $300,000 and your loan amount is $200,000, then what's the loan to value? The difference, the ratio between those two. Do that math. Who knows it?
Not me. I got a calculator for a reason.
We all know it's not my dumbass.
So one of the things that people always, you know, ask and say is that you come into a lot is, oh, but it only needs to appraise for the loan value.
not true. And your house, if you're doing a mortgage, the house needs to appraise for the sales price. So if the house is for sale for $450, even though your loan's only $350, the house has to appraise for the $450 sales price. Ooh, blessed. Excuse
What
me.
end did that just come out of?
I think that was the uppers.
That was the uppers.
And some mortgages only allow your loan to value to be so high. So that's just, it's the ratio of what you owe versus what it's worth.
Fun, because you hear that a lot at the end of your,
Yes.
when you're getting closer to closing. That's when that word comes in to play, which is important. No, there's nothing on your nose.
Itchy.
So often and you're really good about not doing this, although you have an assistant, Jackie, who's fantastic.
Go, Jackie.
She's the shish.
She is the shish. Shiitake mushroom.
Oh, I should have her in here one day.
Oh, you should. But a lot of times people will say, "Oh, I started with my loan officer, and then I didn't ever hear from them again. I heard from like an underwriter, or that their title says processor.
Who's all the people?
Who are those people? Who are who? It's not just you, right? Like
Right.
there's always a team of people behind you. So
Right.
who's
I'm not
behind
that
you?
good. I'm not that good. So you have the loan officer. In my situation, you're going to have, let me put this down. The loan officer, my assistant, my production coordinator, because that's what she chose, and I think it sounds cool. And then after that, it goes to the processing department. They're all the people that do all your paperwork. And then after that, it's going to go to the underwriter, and then it goes to the closer. And not to mention that there are underwriters that check underwriters, and quality control that checks and underwriters, and all the people.
So what does a processor do versus your underwriter? Because there's also underwriters for title. There's also underwriters for your home insurance. And there's processors for those, too.
Yeah. Basically, you can look at it as we all check each other.
Checks and balances.
Yes. So I started off and I put together what I think it all needs. When I do that, then it goes to Jackie, who says, "Oh, so you have the pay stubs and you have all that stuff, but we need a verification of employment." So then she adds more to it. And then it goes to the processor and she goes, "Well, that verification of employment doesn't exactly match that pay stub. So let me call the employer and have them tell me why the year-to-date doesn't match the pay stub to the verification." And so then she does that. Well, then the underwriter gets it and goes, "Well, but if you do the math this way, it doesn't really match this way. So actually go back and ask them this too." So it's like everybody wants it all to match and make sense, and everybody's checking each other, basically, is what it is.
So is it ever smooth where you get a W-2 and pay stubs and your verification and they all are like perfect and peachy and it's fantastic?
Yeah, sometimes if you make $10 an hour and you work 40 hours a week, you never have overtime, you never have bonuses, you never have anything, and you just going. Yeah, sometimes that does happen.
But the ones that it doesn't happen would be like law enforcement, first responders,
Medical,
military.
Yep. Police officers, nurses, doctors, all those people that get all the differential pay, and or your bonus is based off of how well did the company do. Well, you're not going to know how well the company does till the end of the year. And so this year your bonus was $10,000, but last year was $1,000, and this year it's going to be $500. You know, so there's all the things that you have to check.
Well, and then there was, I had an attorney one time, and they were W-2'd, and then he got made partner, and it got moved to K status, which I didn't even know was a thing.
What is that?
It's like worse than a 1099 because they're taxed more heavily. So when he was just a regular attorney, he made more money than he did as a partner because you have to buy in to be a partner.
Oh, so when he did a partnership, it's K1.
K1, yes.
Yes.
And so that's a completely different ball of wax, and it makes you look like you make a lot less money than you actually do. And I was like, "But he's a partner." And she's like, "Yeah, but he makes less now." And I was like, "That's stupid." But you don't have a choice. Like, if you get offered partner, if you say no, usually attorneys' offices are like, "Okay, then deuces."
Right.
Yeah.
And
because you put in a financial stake.
Right. And so if you turn down that financial stake, they're just under the assumption that you're going to leave anyway.
Right.
So they just tell you leave now. Like they just have a good day.
Well, and generally speaking, the better your whole profile is, your credit, your income, your assets, the less checks and balances there are. So, like, if you have an 850 credit score and you're a nurse and you have all this differential pay, they will probably just take the whole picture, do an average of it, and roll with it. Now, if you're a nurse and you have all the differential pay, but your credit score is a 600, then it's just like the stronger you are, the less questions.
Yeah, they
If
just
that kind of
assume
makes sense.
They kind of assume you know what you're doing.
And it also has to do with type of loan you're doing as well.
Yeah.
Like an FHA loan, there's no way to get around the fact that you need 2 years W-2s, 2 years bank statement. Not 2 years bank statement. 2 years W-2, 2 months bank statement. It's 2, 2, and 2. There's no way to get around that. But there are some conventional loans that it's like, here's my most recent pay stub.
Great.
Done.
Thanks.
So it just depends.
Interesting.
Everything depends on everything, I feel like.
You're on a slot.
You guys can help with this one.
Oh.
Foreclosures and short sales. Have you ever done a short sale?
Short
Yes.
sales are not short, by the way.
No.
That is so misleading.
Yes.
I would rather buy a foreclosure over a short sale,
God.
honestly.
So what is a short sale?
Bank owned. And so technically banks own both, but a short sale is the bank's trying to, it owns it, but it also has a large payment. Like there's a large mortgage payment they're trying to
And aren't they
Yeah.
essentially just trying to get the payoff?
yeah, they're trying to just make it.
Recoup their money.
We're trying to recoup their money. And so it's usually like, the payoff is, they're not trying to necessarily make profit, but they also have to pay off the fact that it's not just the payoff, it's that they probably are on back taxes and any other liens attached to the property. So it could be contractor liens and whatever.
Right.
And everything, you might not hear for days, weeks, months.
Most of
about
the time,
this
it's
offer.
when I did my short sale, everything was done via fax.
Yes.
Because they won't allow,
They
and this
do
was
not allow it.
This was just, so I've been 5 years there, so probably 6, 7 years ago. And it was through a big bank, BOA, and I had to fax everything.
I don't even know.
Every single thing. We had to fax for the title company to speak to them. We had to fax for my client to speak to them. We had to fax for all these different things for the short sale. And the short sale literally took, I want to say, 7 to 8 months to end up closing after we got it under contract.
Yeah. So a short sale is when you're buying it from the lender. A foreclosure is when it's already
Owned
left.
by the asset management company.
Mm-hmm.
So, like, in a short sale, the owner's still involved. Because they still need the information from the owner because the loan is still in the owner's name. So, like,
Right.
Susie seller still has this and she wants to sell, but she's in the short sale process because she doesn't want to be foreclosed on.
Gotcha.
And so you work through that, you list it, you do all this, but you have to get certain documents from the bank
Yeah.
and the seller.
It's usually a committee that approves anything that happens with that
And
house on a short sale.
if it's not a local small bank that has it and it's a big bank,
Yeah.
it's so hard.
Yeah, and a lot of times they have already have stuff in the works because they already have investor pool that they've reached out to. So like it's usually like a committee that you have to report to for it. And the seller is involved not to approve or deny or take any offers, but only because they're in financial hardship and they're trying to sell the house for less.
Before it's foreclosed on.
Yeah.
Mm-hmm.
Than what they owe. And so they have to, then the bank has to make up the difference.
Gotcha.
Which it's a very hard, lengthy process. And I think that, like, I had somebody, I think about a week or two ago, ask me, is this in short sale? No, it's foreclosed. It was the manufacturer I had in Marlin.
Yeah.
Well, that means it's just going to take longer. No, it's already foreclosed.
Yeah.
Bank owns it. Asset management company's in place. So, like, it's going to take, no, for the third time. It's you submit an offer. It goes to the asset management company. The asset management company says yay or nay. They sign. They go about it. There's certain documents you have to sign as well. And you move forward. It's just like a regular offer.
And it's
Do they take a little longer at all?
No. if they have their ducks in the row at the beginning.
Yeah, the asset, it also depends on how responsive your asset manager is.
Yes.
So if your asset manager is really responsive, typically they don't want it on their plate. Like, they want to get it off their plate. So
they want to be done with it.
Yeah, so they are, they're doing just fine. They will respond fairly quickly, but they only respond in banking hours. So they will respond 9 to 5 every day unless it's a federal holiday. So on weekends you can submit. Not going to hear anything likely until
It just
Monday
depends
or
on the
Tuesday.
company, because the company that I had did respond on the weekends, and he responded via text.
That's nice.
And that's
So-
not always the case.
No, and it's because they don't want it. They want
Yeah.
to be done with it, because I
Especially
was at
if
that
a
time the
mobile
third
home.
realtor,
Yeah.
and now it's on its fourth realtor because they only give us 3 months.
Mm-hmm.
So now somebody else has it and it's less. Well, of course you're going to sell it with the fourth realtor. It's literally 20 grand less than where we started originally.
And for foreclosures, they can sell they want to sell for as much close to market value as they can. They're not just trying to pay off the loan. They also can make a profit from it, because once it's in asset manager's hands, you also have to pay the bank has to then pay asset manager company. So there's more, they're going to sell closer to what market value would be. Whereas short sales, it's just they're trying to offload that property, but they're not going to just take any old offer.
Yeah. I feel like we used to do a lot of short sales years ago. I don't feel like there is near as many.
No, there's not near as many. People will just let themselves go into foreclosure.
Yeah.
Because they're severed ties from the property, and they'll just deal with the fact that they have a foreclosure on them.
Or they'll claim bankruptcy.
Yeah, they'll claim bankruptcy.
I've sold a few under bankruptcy too, which through a local bank is super easy, but through a big corporation is really hard again. Depends on who the banker is at that point, of how you're going to do it and how you go through bankruptcy court and have to get the order to sell and things like that. And even in deaths, the same thing. You have to get orders to sell. And because I just did that, and it took me 2 years to close that house on 15th Street.
Yeah, and
two and a half.
The other thing about foreclosures is typically it won't have any utilities. So they won't turn on utilities until you're under contract, and then you're in your option period. And they'll only turn them on for a certain amount of days.
And sometimes they won't even do that. They'll tell you, sorry, it's not happening.
Yeah, they will tell you no. They'll tell you it's up to the buyer to pay for those reinstatement fees.
I've had that happen. Because if you do an FHA loan, utilities have to be on.
Yes.
Well,
Or VA
technically
too.
when you're listing, they have to be on anyway, because it's in our listing agreement that the utilities will be on.
Yep.
But they don't care. So I always get that information up front and disclose it up front, that it is on the buyer to reinstate these fees. And if the buyer doesn't buy the property, that's sometimes some of the small rural towns will do it for a $50 fee. They'll reinstate for $50 just for the day.
Yeah.
But some of the cities, you have to actually make a profile, and they'll do the whole thing. You're setting up your utilities as if you own the house. So you set up your whole profile. They run your utility credit score,
Right.
which is bullshit anyway.
Yeah.
Your utility credit score, and you might have to pay a deposit plus the reinstatement fee. So you could be looking at upwards of $250 just to get water on.
For a day?
If
For a
not
day.
more, because sometimes that fee is
Also
it's
late fees.
Yeah, the $250 could be just your deposit because you've never had utilities in that city or that state or that
Gosh.
town, and then you have to pay the turn on fee and all that. So you could be $500 just for a day, also, because sometimes the deposit is high because they don't know you as a person.
Right.
You don't have any.
Credit with them?
Yeah,
Right, so-
or in the town or in the state. So when I first moved here, I put water in my name, and it was really high because I'd never lived here.
Yep. And that was the same when I moved here.
Like
So that kind of leads into the next question I was going to ask you is, so there's utility credit score, which I didn't even know was a thing.
Right.
And your utility credit score is based off of whether you've lived in the area. And it is whether you've lived in the area, if you've ever had that water before, or they can see, hey, this person doesn't ever pay their water bill on time, because utility companies can talk, because meters are all smart meters now.
Crazy.
And so they can say, oh, Bob, didn't pay water for 3 months and then would pay, and then wouldn't pay for 3 months and then would pay, or whatever it is.
Right.
And so they will charge you a deposit based off of your utility credit score.
Right.
So when I moved here, my utility credit score was 0 because I'd never lived in Texas.
Mine too.
I don't think I even knew that was a thing.
Oh yeah, it's a thing because you've lived here.
I guess, yeah.
And so, and so we have utility credit score, and then what we get told all the time is, oh, I looked at Credit Karma. My credit score says that it's 730, and Christina's telling me that I'm at a 620.
Yeah.
Why? What is your credit score? What are your credit scores? And how does your mortgage look at it versus like Credit Karma?
So Credit Karma is has a completely different algorithm. Like whoever's created their algorithm on what a late payment, how many points that is, what a collection, how many points that is. So there is a ton of different algorithms, and every creditor uses mortgage has a certain different algorithm than a car has, than everything. So it's as confusing as it could possibly be, to be very honest with you. So if you're looking at your Credit Karma, what I normally tell people is,
don't.
Yeah. So Credit Karma, number one, it doesn't even
Credit Wise is another one.
Yeah.
Yeah.
That doesn't even show you all 3 bureaus. Most of the time, it only shows you 2 at most. And then, if you're going to use it just to make sure nothing funky hits your report that you weren't aware of. But do not use it for score reasons. Normally, your Credit Karma is, I've seen it from anywhere from 40 to 100 points.
Wrong.
Yeah. Normally, Credit Karma shows it higher than the other.
So so there's Equifax, TransUnion, and Experian. Which one of those is the hardest judger of your credit?
I wouldn't say the one or the other is at all, because the truth of it is sometimes if you have, like, let's say you have a car note at a local credit union, sometimes that credit union only sends to one of them. Sometimes that credit union will send to 2. I wouldn't say that one is more than the other, because every time I think, oh, let's pull TransUnion because it always is the best looking, then it's not.
Yeah.
Because if you have 10 different creditors sending to the credit bureaus, and only 8 are sending over here, and 5 are sending over here, and 2 are sending over here, and you pay all of those 10 creditors completely differently, that's why the scores are all different.
Yeah.
So does that make sense?
And it's in my opinion, credit scores are a scam anyway.
I completely.
The fact that we have 3 is retarded. But we also, mortgages and car payments, I think, but mortgages go off of FICO 8. And so there's FICO 10, there's FICO 12, I think there's even a new FICO that just came out. So I always tell my clients, if you want to start monitoring your credit, download the FICO app.
MyFICO.com.
MyFICO, and you get 1 free full credit report a year.
Yes.
When you do have to pay for it. It's $20 a month or something like that. I don't even know.
It's worth it though.
But it is so worth it because you can actually look through your different FICOs, and so it'll tell you your credit card does not use a FICO 8. Your credit cards use some other type of FICO score. Mm-hmm. And so when you want to be looking, you want to look at your FICO 8, and you want to know, and it'll tell you kind of the way that when someone's under contract and trying to improve their credit score to improve their rate, you can play with the FICO app and say, okay, if I pay this one off, how much will my points go up? And they can usually say, we think it's going to go up about this much.
Right.
And so I always tell people, don't look at Credit Karma, don't look at any of those things, just use MyFICO.
Well, because Credit Wise it'll say, I'm looking at it, people tell me all the time, I'm looking at my Experian. Your Experian from who? Is it from Credit Wise or is it from MyFICO? Because there's so many different algorithms, and I think it's Credit Wise that says they use Experian, but which FICO? And so that's why it matters. I mean, and there's a lot of things in the works that they're trying to get more regulated, because one of the things that's super frustrating when it comes to credit scores is the credit reporting agencies are selling your information.
Yes.
And that's extremely frustrating, because if you go down and you apply for a mortgage, your name is sent out to thousands. Mm-hmm. Thousands of people. And which is why you need 2 go to optoutprescreen.com before you do anything when it comes to credit, because that's why your phone will start blowing up.
I've also started to tell people after they close on a house to freeze their credit scores. And
you can freeze them.
You have to unfreeze them for a period when you're doing your mortgage.
Yes, but you can call, have them unfrozen, have us pull your report, and freeze it right back.
Yeah. I tell people to do it afterwards because of your information being sold. So I've definitely said that before. I tell my people that. But also, that only freezes your credit score. There is, and I can't remember, I'll have to look it up and post it on social media, but it's like eCheck or eBank or something like that. That also freezes from anybody opening bank accounts in your name, because you don't need a credit score to open a bank account. So people can open bank accounts in your name if your information has ever been leaked. And so they can start impersonating you. So
how do you find that out about children? Like, I'm still on this, like...
Oh, Jillian.
Yeah. I can't pull her credit report or anything. I have to send in a bunch of documentation to...
That makes no sense.
Like, Experian just to see if she has a report because someone stole her identity. I don't have a clue.
And you found that out when you filed your tax returns.
Yeah, 2 years ago. And then it hit me again last year. So for 2 years, I've been hit with her identity being stolen, even though she had a PIN number last year.
I don't understand how that's... I'm so shocked at how that's...
And she doesn't have a normal vanilla name either. I know that sounds... But, like Joe Smith or...
Yeah.
No. Meaning they know her in her full name.
Yeah. It was leaked somewhere. And, I got a notice at some point that, like, everything is so techie now that, like, not necessarily my medical chart, but parts of my medical information could have been leaked through the MyChart app. And I got, like, a notice about it.
What?
Which is weird because, like, I've never used any of that with her.
Yeah.
Because we've been through, like, Providence. And Providence has something.
But they may have been part of a data breach because Providence got bought out by Ascension.
Yes. And so, but it's super annoying that I still, like, can't figure out how to run my own child's credit report.
And you've called Experian and they still won't help you?
No, I have to send in her birth certificate. I have to send in all this information about her that can then get lost in the freaking mail to prove that she's my kid, even though someone else has stolen her identity.
So when you called Experian, you can't...
They won't give me anything over the phone.
Do you have to send the originals?
I don't know. I need to look again. But I have to send all this information.
Because I remember when I did my passport.
You have to send your originals.
You have to send your originals, and that was terrifying to me. Because it's like, what do you do?
I had to send my originals for something. I don't remember what it was.
Yeah, and that's scary because the mail sucks.
Scary. Well, the mail does suck, and you don't get to send it to, like, something that you get a certified slip back. Right. It's always, like, a P.O. box or something. Or it says you cannot send this certified. I'm like, then let me go to an office and drop this off.
Yeah. So I'm still like, why is that a thing? Like, why can't I look until she's 18? Well, I got 11 years, if not more. How old is she? 7? Yeah.
Well, and why can't the IRS track who it is?
Exactly.
They should be able to see her social security number on somebody's, like...
Why can't they deny her? Why can't that one? Oh, because it's a first come, first serve. So I have to get mine in before them.
And you have no idea who it is, what state they're in, or anything.
No. So I have to, still haven't submitted yet, but I'm trying to do it so I don't have to do an extension. Because it hurts me financially.
Yeah.
Because I lost my child dependent credit.
Yeah.
Like, I don't get to claim my own child for 2 years.
Surely you'll get it back.
They'll have to back tag.
They haven't yet. But my taxes have been accepted both years, and I'm just paying on it.
Yeah, but you'll have to, once you can prove it, you'll have to, like, you have to be able to go to court or something and get that fixed.
They're still looking into it. I just did air quotes. And that they need another 60 days is the letter I got at the beginning of March, which is the letter I get every 60 days.
That's ridiculous.
For something that was submitted back in October of 23 was when we learned again.
That's insane to me. Like, I just feel like I would make a lot of noise about that.
I don't know what else to do.
Make a lot of noise. Get the media involved is what I would do. Like, I mean, that's how you get anything solved nowadays.
I can't do that.
I'm
not confrontational enough to do that. I hate confrontation. Okay, but back to mortgage. Sorry.
No,
I'm just
it's
curious of how you get a child's.
I'm not sure.
Like-
because I know how I would go on and get mine, but I've never tried to do. I don't know what the difference.
I've
would
put
be.
in all her information to like get an account and stuff. Nope, because she's not 18.
Yeah, I don't know. You might be able to call each reporting agency, but
I'll try.
so anyway, the point of it is there's a lot of lingo that you're not required to understand,
That's why we have Christina.
and you can ask questions. You can ask your realtor. You can ask your lender. You can ask whoever. Don't be
Make
afraid
sure
to
your
ask.
realtor knows, though. Like, make sure
Yes.
they're educated, because asking them doesn't mean that they specifically know the right answer, and they might be feeding you a line of bullshit.
Well, and it's also okay that your realtor says, I don't know, but I'll find out.
Yeah, that's me.
Like,
Yeah.
Always. I'm like, oh, I think I know, but let me double check for you, and I'll let you know.
And I would also say that if you're asking about lending questions, while your realtor may know the answer, it's not a bad idea to also check with your lender as well.
I
Yes.
always refer mine back to the lender. I'm like,
I do too.
this is a great question for your lender, and a lot of times I then will loop it into a group text, and I'll be
I
like,
do that too.
hey,
Yes.
Christina, Joe has some questions.
Right.
I think I answered them, but I really wanted to get your thought on them as well.
Yeah, because and I don't say this rudely, but there are some agents out there that put out misinformation. There's lenders that do it. There's realtors that do it. The point of it is don't be afraid to ask. Don't be afraid to fact check.
Well,
There's nothing wrong with questions.
The reality is that we're in two separate lanes, right? Like,
Yes.
I don't know, although people think that all the information is out there in the open, like, what a lender holds confidential is a lot. And so, like, I don't
Right.
know how much money you make
Yeah.
unless you tell me. I don't know how much money you make. I don't know what your debt is.
Yeah.
I might know your debt to income ratio is 42%, but 42% of what?
Yeah.
Like, I
Right.
don't know any of that information. So, although I'm answering to the best of my ability, it might not be the right answer because there's a lot
so
of
many
nuances.
factors, and
Yes.
there's a lot of things we don't know either.
Right. You're the property. I'm the loan.
Mm-hmm.
And there's nothing wrong with saying, I'm not sure. Let's call Jenn.
Mm-hmm.
Yeah. So don't be afraid to ask questions, because there is a lot that's into it, and some of it's even like you can't really explain in a 2-minute scenario. So
Yes. So, ask us your mortgage question so we can grill Christina some more because she loves it.
I love to be put on the spot.
She loves to teach.
She does love to
I do
teach.
love to teach.
She does love to teach. So, let her educate you on all things loan. And we'll see you guys next time.
Bye.
Bye.
This has been Real Estate Misfit Moms. Don't forget to follow us on socials at Real Estate Misfit Moms and bookmark our podcast so you never miss an episode. Remember, miss, you fit in here.
This has been a Rogue Media Network production.